Have you ever seen the movie Groundhog Day where Bill Murray is doomed to relive the same day over and over again?
Do you ever have deja vu, Mrs. Lancaster?
If you pay attention to the financial news, you may be thinking that you're living in that movie right now. That's because it's the time of year where you're seeing articles and interviews with people from the big financial institutions making bold predictions and forecasts about the market with certainty.
Economists have predicted 9 of the last 5 recessions. Let that sink in for a minute. The pros, who claim to have a crystal ball, are wrong most of the time.
Yeah, my crystal ball broke years ago.
And I lost mine not too long ago too. And if you don't believe us, then keep watching and we're going to show you how their 2024 predictions and how wildly off they were. We're also going to tell you how to ignore all the noise you're going to be hearing this time of year and how you should stick to your portfolio to get you through the decades, not just the years.
Wall Street's 2024 projections for the S&P 500 revealed uncertainty, with the average forecast at 4,861, yet the index closed at 5,881, a 21% increase over the estimates.
And it's not like 2024 was a one-off. The forecasts from the Wall Street pros are wrong almost every year. Let's take a look at how wrong they were in 2023.
Yeah, right here you can see, okay, Credit Suisse missed the actual by 18%. JP Morgan was 14% off. Bank of America missed it by 19%. Goldman Sachs, they would have you believe that they're the best of the best in those fancy suits. They missed it by 19%. And here we go, Morgan Stanley. I hope you don't invest with those guys. They missed it by 22%. They were all dead wrong in 2023. You're paying all this money so they can have their bespoke suits, drive Ferraris, and have meetings in their wood-paneled offices. For what? They don't know any better than you or I, and the data is clear.
For years, you've been the butt of their jokes, and they've convinced you that somehow all of their manpower can predict the future, and the use of insider knowledge can gain a competitive advantage. The data is clear. It's simply not true.
Take a look at how far off the Wall Street forecasts are going as far back as 2018.
So in 2018, they were off by 14%. And if we look at 2020, they were off by 14% again. And then in 2021, believe it or not, off by 26%. And then like we saw earlier, in 2023, we were off by 12%. So Brad, if we can't accurately predict the future, then what can we do?
We diversify. Diversification will protect you. One major way to be diversified is by using ETFs because they're low cost and tax efficient. Let's take a look at a chart of what diversification would look like for you. So each one of these colorful boxes here are different asset classes. You know, things like stocks, bonds, cash, real estate, those sorts of things. And every year you'll see there is a different winner and there's also a different loser. And if you use a broad mix of all these different asset classes, you're going to ensure that you're never once in first place, but in exchange for that, you're never once going to be in last place. So let's take a look at the white box here. And the white box is a mix of 70% stocks and 30% bonds. And you'll notice something interesting about the white box, that it's never once in first place. Just like I said, it's always somewhere kind of in the middle. And yet after 10 years, this is the most recent 10-year period, this white box finished, again, in the middle with returns of north of 8% per year for a decade. That's fantastic. So the diversification is going to protect you and help you weather the storms and get through the turbulent markets that we've had in the past and that we're certainly going to have in the future. And the reality is, nobody really knows what the future holds in store, and that's why you diversify, because you embrace the unknown. You embrace the uncertainty, and the best way to do that is how I've just shown you right here.
So all the Wall Street gurus were right about one thing. The S&P 500 did go up, and it's been red hot. So why not put all our eggs in one basket?
That's a great question, and it is one that we get asked, but the answer is really clear, and it's because any one of these baskets can go ice cold for years. And so what we're looking at here, this is the lost decade from 2000 to 2009. And you remember the height of the dot-com bubble there in the late 90s, And then we had the tech wreck, 2000, 01, 02. We had 9/11 right in there. We had a few years of recovery, and then we had the mortgage meltdown of 2008. And so you can see that in that decade, the S&P actually lost almost 1% per year for an entire decade. So if you retired there in 2000 and you were taking roughly 4 to 5% out of a portfolio that was all in the S&P, guess what? You went back to work in 2016. That's right. You're the Walmart greeter at that point in time, okay? And so in that period where the S&P 500 went ice cold, you can see plenty of asset classes, U.S. small caps, U.S. value companies, international, emerging markets, red hot opportunities. And so a diversified mix, a globally diversified mix of stocks would have weathered that storm that for the person who put all their money in the S&P 500 turned out to be a lost decade. And if you're sitting there and you're going, well, that was a one-off, that was an anomaly, it's not true. From 1966 to 1982, the S&P 500 underperformed cash, bonds, and inflation. And also 1929 to 1941, the S&P 500 was underwater for over a decade. So if you think it can't happen again, think twice. And that's why you want to protect yourself and diversify.
Okay, Brad, we all get it. We shouldn't put our eggs in one basket and not in the specific basket that happens to be the most hot at the moment. But diversification doesn't feel that great along the way either. So let's take a look at this chart and show you what you're feeling if you're investing correctly. So what we're looking at here is a time frame from 2000 to 2023, the end of 2023. And if we look at the right here, you'll notice all the emotions you feel through this period. And most of the time it's, I lost money, or I didn't make as much money as the S&P. I lost money again. But if we go through the ups and downs with the globally diversified portfolio, in the end, you can see here that you actually beat the S&P 500 by a little bit, but those ups and downs along the way are significantly less. So more than likely, you're going to be able to weather through that storm a lot better. So if the big firms are always wrong and they cost too much, then what can we provide that they can't? Can Seaside predict the future? The short answer is no, but we're not even in the forecasting business.
With the big firms, they hang their hat on trying to beat the market and outsmart Wall Street. Clearly, they're not delivering on this promise, but we're going to help people accomplish their goals in a low-cost, diversified manner. Our portfolio management is good, and we're going to do it better than the average person, but that's not where our real value lies. The real value is in the planning, the rebalancing, tax loss harvesting, tax planning, estate planning, coordination with your other professionals like your CPA and your attorney. That's where the real value lies. In fact, Vanguard suggests that this holistic approach is worth about 3% per year. In other words, working with the right financial advisor is going to bring about 3% of extra value to you every year by maintaining discipline around these things.
There is one thing we know about the future, is that it's uncertain. And if you don't want another year to go by without you building wealth and you want a guide to help get you through, that's where we come in. Feel free to give our office a call or send us an email.
Make sure to like and subscribe to the channel, and we'll see you on the next one.